Hey guys, Ty Lassiter here, CEO of KeyCity Capital, and I'm with Stephen Patterson, our Chief Client Officer. I'm actually excited about this. You've been with our business now and in KeyCity Capital for a little over a year, going on 2 years now, actually.
2 years.
So let's talk a little bit about, you've got a unique approach into our business. You've been in the financial industry for quite some time. You've been in the education space. You've had an amazing career dealing with post-retirement and pre-retirement dollars, managing investors' capital, and now the private equity space. Kind of talk to me about that transition and what that looked like for you.
No, thanks. I lean heavily on my own background. I think financial services is about educating the populace. By and large, I don't think people always understand how to put their money to best use. And so when we can start at ground zero and say, okay, what are your goals and what are your timeline? Then we can start plugging in investment strategies that make sense. The private equity space offers returns that typically can exceed the market. I love the alternatives that we've gotten involved in, because what I find through most of the individuals that we come into contact with is that they have a decent amount of capital in the public investments, but they have nothing in the alts and really are somewhat uneducated about where alternative investments can take their portfolio.
You brought up a good point, and you said oftentimes private equity can outpace the financial market. We found, and I've gotten into private equity because most of the general population that has investments, they manage investments, don't have access to private equity.
Yeah.
You talk about an education aspect to that, and you use the word alts and alternatives. Maybe kind of share with us what is an alternative investment? What does that look like?
So we're talking about items like business ownership. We're talking about items like real estate, multifamily real estate being a great example. Those investments are not tied to the stock market. So the stock market can be up, the stock market can be down, but it doesn't necessarily have a direct impact on the value of the real estate, nor the cash flow on the real estate. So it gives a hedge inside of the portfolio of our client that they wouldn't otherwise have access to.
So you brought up a good point. You said business ownership, real estate ownership, financial market, you invest in a stock, that's by and large part business ownership, but you have no decision-making process. You have no impact on that business. It sounds like, so you're explaining the ownership of physical assets. So talk to us about, we've got about 550 clients now. Talk to us about the importance of ownership of physical assets that many of our investors like to have. That's something that they're looking for. Talk to us about that physical ownership a little bit.
Sure. One of the things that I often hear is my portfolio is up, or my portfolio more recently is down, but there's usually not a deep understanding of why either one of those events occurred. And that's because a lot of the stock market trends that we run across are purely behavioral. People are buying or people are selling, and it may not be the right time to do either, but that's affecting the overall price of a stock. That overall price of that stock ultimately affects the overall value of a portfolio. What makes real estate and direct business ownership interesting is, on the first of the month, rent is due. And so it cash flows. So whether the stock market is up or down, on the first of the month, rent's payable. So it produces a consistent return. The other thing that we can identify in real estate specifically, and I think we've seen it across the United States for sure in the last 10 years, is just the annual appreciation that goes on with real estate. So when we're buying an asset that's not only cash flowing on a regular basis, but has an appreciation component, so that when we go to sell that asset, there is a layer of earnings placed on top of that cash flow, it can be particularly meaningful to the overall portfolio.
You brought up a couple of really good points, and it's what I've always shared with our investors, with our listeners, with people who are interested in getting invested with us. Really the four key components as to why I focus on physical assets and why private equity. You brought up cash flow, you brought up growth. One thing that you didn't talk about was the tax advantages of these types of investments. But really, that fourth aspect of having physical ownership. Market could be up or down, and it doesn't impact what our investments do. What impacts what our investments do are the operators of the business. How are the operators handling that specific business? And so, those four key things are what drive the interest in most of our investors. Most of our investors are hitting retirement age, or they're planning for retirement. Maybe they're in their 30s, mid 30s, like myself, and they want to be able to retire early though. Like, I foresee myself doing this for a long, long time. I enjoy what I do. But we've got a number of clients that are doctors.
Yep.
And those doctors are looking for, they want to get out of practicing maybe in the next 10 years. So maybe you're 35, 36 years old and you want to be done by the time you're 45, or at least scaling back to 2 or 3 days a week and letting your investments work for you. The unique thing about private equity and about real estate investing, like what we focus on, is that you've got cash flow. So when you invest, you're not having to sell a stock to generate that cash flow for you. You invest in something, the money stays invested and it continues to grow while the revenue of that business or that property is delivering the cash flow. Then at the end of it, it grows, right? And so you've got that growth aspect that you mentioned as well. So tell me about, you went from the financial market and really dealing with financials and stocks, bonds, and mutual funds. I know you have talked to me quite a bit at length that, it was just, you continue to feel a tugging that there was more out there for the clients that you worked with. Kind of walk through that.
Yeah, my first exposure to private equity was probably 10, 12 years ago. And what we were looking to do with a very, very large portfolio at that time that was being managed was just create a consistent income stream with a growth aspect to it. And so our CIO that I was working hand in hand with started bringing different private equity offerings over for us to evaluate, to see if they fit with the overall investment design. And what I began to see in those is not only were we seeing growth, we were seeing tax advantage that was significant to the client that we were working with at the time. And then I think the third piece was just there was a consistency of earnings that you didn't find. You can have a great 6-month run in the market, and then you have a 6 months of either stagnant, flat, or even a decrease, which was directly affecting cash flow for this particular group. And so when I looked at the private equity offerings and saw that we were not only getting a consistent cash flow, we were getting an appreciation and a growth overall, and then coupled in with the tax advantage of direct ownership, right, that you're not getting through an equity platform. It just made a lot of sense, and so we started carving out a large space in that portfolio for private equity placements. Where my mind began to go with that is, why are we not able to get that to the average consumer? Why aren't we able to go to middle America with the same opportunities that are being presented to very large, very wealthy owners of these types of assets?
Yeah, most private equity is only available if you walk into your bank. You've got to have a minimum $10 million in a CD or a checking account for that bank to offer you these private offerings.
Yeah, every brokerage house, every bank has their own set of rules. But yeah, it's typically a high hurdle to get exposure to private equity.
10 million, sometimes I've seen 20 million at some places.
And so when the opportunity with KeyCity came about, and there was an ability to go out to the average consumer, the average investor, that yes, they were accredited, but they didn't have $10 million. They didn't even in some cases, may not even have $5 million of net worth. But we were able to find a way to plug this in. It's just been a dramatic change. And so we look at the overall financial portfolio of the client and try to see what is an appropriate investment for the resources they have to give them a hedge against inflation, to give them a hedge against decreases in the market. And then for our retirees to try to create a consistent cash flow that, 15, 20 years ago, maybe we were finding in the bond markets, but we haven't seen that in quite some time but due to what's happened to the bond markets.
You talked about the hurdle to get in at most brokerage houses, at most of the banks that you walk into. You briefly described the hurdle that we have. Guys watching this right now, everyone that's watching right now, you can check us out at keycitycapital.com/podcast, KeyCityCapital/podcast. You can check us out on social media, follow us on YouTube. Wherever you're seeing this, there's probably a link down below where you can go check us out. But you mentioned that hurdle. What is that hurdle for KeyCity, and how is that different than most of the brokerage houses that somebody would go to, both in terms of minimum investment, which is the hurdle we were talking about just a minute ago, and then as well as accredited investor? You mentioned accredited investor. What is that?
Sure. So minimum investment for KeyCity Capital offerings is $100,000. We can work with qualified and non-qualified money. But however, all of our clients must meet the SEC definition of accredited, and that's for a couple of different reasons. A Regulation D fund offering comes with a particular set of rules, and one of those is that all of our clients must meet their definition of accredited. There's two pieces to that definition. The first piece is on annual earnings. So for an individual that files taxes singly, that's $200,000 of annual income in the previous 2 tax filing years, with reasonable expectation that will continue in the future. For couples that are married, same rules apply, but it's a $300,000 annual income.
And that could be 300 from one, or it could be a combination, 150 and 150, or however that meets up. Yeah, for
Absolutely,
the household.
For the household. Now, if you don't check that box, that's not a problem, because the SEC gives a second piece to this definition, and it's $1 million of net worth, not including the primary residence. So that's 401ks, IRAs, other
rental vacation house,
other rental properties, other assets.
All your stocks, bonds, mutual funds.
Stocks, bonds, mutual funds, brokerage accounts, savings accounts. So when you add all of those things together, with the exception of the primary residence, $1 million of net worth, then you become eligible for placements like this.
And that's either or. It's the income piece, 200 or 300, or 1 million. You don't have to do both.
Yeah, and so what I often find is we have younger clients that may not have the overall net worth, but they do a really good job of producing an income. That's great. We have an opportunity to work with you. I have older clients that may be retired. They're no longer earning that type of income, but they have a net worth, and they're just looking for an investment in their overall portfolio through existing IRA funds or through cash on hand, and it's an opportunity for us to work with them. So it does not have to be both, and it's for a reason. It's so that we can get a broader range qualified, but it's also to make sure that it's not an inappropriate investment for the client.
You mentioned qualified and unqualified dollars, and then you just talked about the 401k. So I'll let you share a little bit about, but what he's talking about is, yes, we can take both cash dollars, and then we also take IRA money or retirement dollars.
That's right.
Kind of walk through that, what that looks like with us.
So, let's say that it's an individual that spent the bulk of their life, like many Americans do, and they've contributed to IRAs and they've contributed to 401ks. Those are qualified dollars. They have not been taxed. They will only be taxed in retirement as you draw them out. The way we can work with you with an investment like that is we go to a self-directed IRA platform. We typically use a variety of different providers, and we can transfer those dollars into a self-directed IRA that creates a non-taxable event for the client, and they can place that capital in one of the investments that's sponsored by KeyCity Capital. Individuals that are working with cash, maybe it's a brokerage account and you're liquidating some assets, or maybe it's just a savings account and you've accumulated some dollars that you want to put to work. Much simpler process, and that can be done depending upon the day in a 30-minute to 2-hour time frame.
So we were talking about a little bit the hurdles to overcome, and specifically a bank or a brokerage house, you walk in and Mainstream Wall Street private equity typically has a hurdle of $10 to $20 million in some cases. But then you've got other operators like ourselves. As we talk about those hurdles, there's a number of other operators like ourselves that have a $100,000 hurdle. One of the unique things that we do differently that I think drew you to KeyCity Capital was our diversification and the private equity focus that is just vertically integrated in real estate. Most of the real estate operators do single syndications, or what we call a single syndication. Yeah. They'll raise money, and they'll raise money for one deal only. And then they'll invest that money in that one deal, and then they'll move on to the next deal. Kind of walk through the pros and cons of that approach versus our approach of having more of a diversified portfolio for our investors. What does that do for them?
What happened is there was a money manager that picked 10, 15, 50 stocks, and he had an investment thesis around those stocks that was going to produce a return. What we do at KeyCity Capital is very, very similar, but we're doing it with real estate assets. And so we're buying 6 to 10 apartment complexes in one of our real estate fund, and the cash flow off of those apartment complexes and the overall appreciation on that asset ultimately is producing a return. So we create an investment thesis around those assets. What I like about what we do versus others is a single syndication puts all of your eggs in one basket. That one asset has to perform or you don't get paid. If that asset has a disruption in business due to fire or other act of God, you don't get paid. Whereas when we're spread across multiple assets in a fund, I think it's better for our clients because it gives them a greater diversification and it gives the client more security in knowing that their investment is spread across multiple assets with multiple cash flow streams.
So you brought up a good point about the diversification, but also how a specific event can affect or impact how an investor does in a single offering versus a fund. We did a $100 million deal in Memphis, Tennessee, bought 6 assets there. In that same fund, we bought 5 assets in Montgomery, Alabama. That was about $60 million placement. So in those 2 funds, we've got those 11 assets. One asset, the one in Memphis, having about a $15 million capital expenditure business plan. We underwrote that for 3 years. So it's going to be about 3 years before that one is delivering the cash flow at full effectiveness and at top of what we underwrote for. But the one in Montgomery is only about 12 to 18 months. I think we're already hitting our stabilized asset value in Montgomery. And so that's a very good point there that, we spread out the diversification. We've got one asset in Memphis that is probably going to have a little bit higher upside than Montgomery does, but it doesn't have quite the strength of cash flow. Then in Montgomery, we've got stronger cash flow, not quite as high of an upside. You pull those together and it creates a great opportunity for those investors.
Yeah, that's right. I mean, I'll equate it to you wouldn't take all of your retirement assets and put it in one stock. You wouldn't take all of our retirement assets and put it in one piece of real estate. Diversification is the key to success in any investment philosophy. In this philosophy, we're saying that yes, there are assets that outperform others, but by diversifying across multiple, we decrease risk for the client and still produce an overall return that is favorable.
So with this, and obviously I see the excitement in your eye about the product that we offer.
Sure.
And I know you enjoy it. So and time has flown since you've gotten here. So you're approaching what, 18 months or
right at 2 years.
Right at 2 years. Mm-hmm. So right at 2 years. And when you came on, we had, I think, 110 investors.
110.
And we're at 550
A little
now?
over 550 now.
Okay. So what has led to that success? You have, in your 2-year span here, you have more than doubled our investor basis, or you have more than double exceeded what we had accomplished in the 3 years prior to that. What has led to your success?
Sure. Well, I think first and foremost, the proof's in the pudding, right? So the investments must perform. When our clients see investment performance, they get excited about it. So, number one, I think our acquisitions team and our operations team do a good job with the assets that we go out and buy. And that produces a return to our clients that everybody can get excited about. But number two, I think that it's just the approach to educate clients. I think private equity has been a scary space for middle America. It's not something that people have had an opportunity to get a great amount of exposure to. They don't hear about it from their, local advisor. And so when you approach them with, let's start at the ground floor and build on your knowledge base, it makes sense to people. They can understand that on the first rent's due, on the 30th, they receive a payment. And in between those days, accounting's producing a statement, and they're making distributions to our investors. And so it's logical. When you ask people why the markets are up and down, typically you can't get an answer around that. But when you ask them, well, how does KeyCity Capital pay you? And we can walk them through the investment thesis, people can explain it. And when what they understand, they appreciate, they enjoy, and they invest in.
So you mentioned a couple of good things about the distribution. So on the first, rent's due. On the 30th, distribution goes out. What does that mean for investors? We've got about half of them that take those distributions, half that don't. What does that mean to an investor?
No, I think it's a consistent cash flow return is what it means to them. It's something that they can count on. There's a consistency to it, and there's a tax advantage to it. And I think that that's a huge piece that sometimes gets left out of decisions when thinking about where you're going to place dollars, is not only what does it earn, but what is the tax implication to the client at the end of that.
So when you started here, well, let me rewind before that. When you finally started here,
yes.
I think we went back and forth for 3 or 4 months, and you kind of dipped your toes in and dipped your toes out. You were coming from not really a different industry, but from a different space in the industry. We've talked about it a little bit. And you mentioned a minute ago that most people's local financial advisor don't share private equity. No. So what is a local financial advisor that you're referring to? Because you're actually registered as a financial advisor. Share a little bit about that.
Yeah, I mean, your Series 7, Series 66 advisor that takes care of your portfolios. Great individuals, hardworking individuals, but oftentimes don't have access to quality private equity to provide to a client. So the question becomes, number one, why not? And number two, what are the barriers? And part of the why not is because it's typically private equity investments are illiquid investments. So once you're in a private equity offering, it's usually for a period of 3 to 5 years.
You're making a capital commitment. Yep. It's not you buy it today, you can sell it tomorrow.
You can have your money. In a private equity placement, you're making more of a commitment. And so that can sometimes be a scary aspect of this.
Wanting somebody that has the liquidity to be able to make a $100,000 capital commitment for a 3 or a 5 year period.
That's correct. And so, with that thought, that sometimes is a distraction for the local advisor. When I looked at it and said, we're going to work with accredited investors first and foremost, and we're going to make responsible choices with how we present this. How we invest the amount of money with the client that we're going to invest, and this is going to be a portion of their overall portfolio, then it became an opportunity to produce a yield in the alternative space that a lot of people aren't working with. And I guess I have somewhat of a pioneer spirit in me, and the more comfortable I got with the strategy KeyCity Capital was using, and the more I began to reflect, how do we incorporate this with the traditional middle American household, the more it made sense for me.
Yeah, I mean, our focus is go in and how quickly in a 5 to 10 year period can we double an investor's money.
That's right.
And then redeploy it and do that again. And along the way, oh, by the way, you're getting cash flow. You're able to retire a little bit early and live off of that cash flow, or you're able to reinvest that cash flow and grow quicker while you're still in your working years. Or once you retire, now you have a nest egg that's built up and you can commit to that 5-year time frame and just live off that cash flow as you go.
Well, and one of the things that I often heard from clients was, hey, I really have an interest in real estate. I know I can do well with real estate, but I don't want the hassle of it. I don't want the 2 a.m. phone call that the hot water doesn't work or the roof is leaking.
We get tons of investors that come in, they have a portfolio and they say, I'm done with these problems. Or maybe they've owned that portfolio for 10 years and it's time to put capital expenditures back into it. That's right. And they're not in a situation to do that. They don't have the relationships. They don't have the scalability.
They don't want to deal with the contractors.
Yeah. We've got 5,000 units. We have primary vendors that they come to us first. And so if you have 10 units and we have 5,000, we're going to get a better price and we're going to get faster product. You're going to be waiting longer and you're going to be paying more. And so those investors come to us and say, look, I can invest with you guys, or I can sell you my portfolio, and they are going to get a better return, allowing us to manage that issue or that problem for them at a more effective and more efficient pace.
That's right.
So,
yeah. And when you can point that out to the client and say you're going to get the same advantages that you were getting when you were running 5, 6, 7 rent houses, only now I'm going to diversify your risk across a portfolio of assets across multiple economies in the southeastern United States, and you don't get the phone call that the hot water won't come on, it becomes very appealing.
And for those listening, you can check out a little bit more about our offerings and what we do. As I said, you can go to keycitycapital.com/podcast or just keycitycapital.com, KeyCityCapital.com. Check us out, follow us, Stephen Patterson, myself, Ty Lasser. But Stephen, let's end with this one. So I'm going to go back to the 3 to 4 months that it took you to finally decide, yes, KeyCity Capital, and why KeyCity Capital. You had an opportunity with a group in Boca Raton, Florida. Mm-hmm. I mean, who wouldn't want to live in Boca Raton, Florida? But you chose KeyCity Capital here in Southlake, the Dallas area of Texas. You're a Texas native, but that opportunity in Boca was a great opportunity. Now, since we've got an office in Naples that you like to spend a lot of time at, but share a little bit why KeyCity Capital, and then expand on our Naples office maybe a little bit there.
Sure. At the end of the day, it became a trust factor with the partners in our firm. When we're doing business together, I want to know that we're working with ethical people. I want to know that we're working with experienced people, and I want to know that I'm working with people that put clients first. And
you make a good point there, and I know you always mention this. You come to me, and when we're making decisions as a company, you always say, and you'll name a client's name, and you'll say, remember, this is their kids' college money. Or remember, this is their life savings that they're passing on to their kids. That's a good point. Kind of expand on that a little bit.
Yeah, I mean, when I saw that, number one, there was an ethical treatment of clients. When I saw that there was a true investment opportunity here that wasn't here for a moment, but this is an opportunity to build wealth over generations and over years in a real estate portfolio. And then when I saw that KeyCity Capital emphasized a client-first approach, those are values that aligned with me internally, and I wanted to be a part of that. I wanted to see the success that could be created for clients through KeyCity Capital, and ultimately the success that could be created for KeyCity. I'm a believer that we receive what we pass on. Right? What we put out into the universe will ultimately come back to us. And when we're putting people first, when we're putting clients first, when we're putting tenants first, then there's a win-win for everyone. It's not just investors winning, but tenants win because they get a better property, they get a better management. Cities that are excited about when we come in and buy those assets because we go in and we improve it. And when we improve those assets, we're improving communities, we're improving livelihoods, we're creating local jobs because we're doing renovations on the units. So there's an improvement to the overall tax base of the community. To me, that's building something that's sustainable and that's meaningful. It's not just about making a dollar, but it's producing a return to all involved.
Thank you, Stephen. I think you made some good points there. Guys, if you want to check us out a little bit more, like I've mentioned, go to our website, keycitycapital.com /podcast, or just keycitycapital.com. You can also check us out. We were talking about our office in Naples and our office here in Dallas. We do monthly dinner events at both locations, so we're always having a dinner event where people in the community come check out what we're doing, check out how we can work together with you, or just learn more about real estate and about investments, how to make good investment decisions. So come check one of those out. You can see when our next one is on the website, or follow us on social media. You can follow us. I'm Ty, T-I-E, Lasseter, L-A-S-A-T-E-R, Stephen Patterson, S-T-E-P-H-E-N, P-A-T-T-E-R-S-O-N. Check us out on social media. Follow us on YouTube. I look forward to connecting with you guys and look forward to seeing you at one of our next dinner events. Thank you.